Yeah, I trust you.
We should have brought out samples, you know? Nobody really does that.
All right,
That's
so
unusual.
we will get started. We have JRJR Networks. Presenting today is John Marchand, CEO. Tucker Gig and Investor Relations. So JRJR is traded on the New York Stock Exchange, ticker JRJR. So with that, we'll get into the presentation and Q&A. So.
Can we get them to close the doors?
Yeah, I'm going to do
Well, thank you very much. Coming to Vegas is no small thing, I thought. This could be like a fraternity party. And I got to Vegas, and it's like getting to a fraternity party, and you walk in, and your mother's in the room. This is not a good thing. But let me introduce Leslie Marlowe here. She is the person who keeps us squeaky clean. She's an SEC and M&A attorney, a good friend of the company's, and as I understand it, we've in fact already filed this presentation as an 8K. So you can take notes if you want, you can get it online if you like, but I think we're also one of those companies that people really like to hate. I just feel like people are at that stage where they're not so happy with the company for some good reasons, right? We're late on filing, we changed auditors, and we're late on filing Qs. There are no accounting issues that need to be resolved, but you know what? The trial balance in Russia is not balancing out right now, and we're gonna have to wait till it does. But there are no issues that are material, and we've, I think, put out numbers that suggest that we're in pretty good shape on that front. We're a family office. We're a group of people that have done a lot of transactions with excellent results, I think. We have a history over 30 years of returning 92.7% on an annual basis. That's probably one of the best around, and people will say, well, you know, how do you do that? And we're turnaround guys. So we do messy deals. It takes 3 or 4 years to get them to start to feel right, to get the revenue line built back up where you want it to be, many times to simply stop the decline in revenues. But we don't pay much for the companies that we buy, and you know, my own financial opinion is that you gotta buy it right? You just have to pay the right price for an asset, and if you do, then you have the option to make it work and to get large returns. If you overpay, you're toast from day one. So we have a powerful philosophy of not overpaying. We have a view on how to fix the revenue lines of these companies. We hold patents in areas of marketing, consumer behavior, and decision making. Those are on our website. You can look at those if you like, but we take a very quantitative approach to the top lines of consumer goods companies because we feel like we have a special understanding of how to figure out what the positives and negatives are related to the brand equities of these various companies. And so we take a very mathematical approach to identifying the negatives and neutralizing those, identifying the positives and reinforcing those. And it's been a model that has been responsible, I think, for a lot of the returns that we've been able to achieve. There are large companies. I was the former chairman and CEO of Mary Kay, the largest shareholder of Avon. If you look at any of Armor Holdings, if you look at any of our deal history, you'll see that these were companies that needed a lot of work on the top line. But eventually, they bent, and for us, our average duration is 14 years. So we're believers in fixing companies, but not getting out when your returns maximize in the 3 to 5 year period of time. As most private equity firms like to do. We're in it for the long-term total capital appreciation that we think you achieve out in the 10 to 14 to sometimes 20-year period. And we're not the only ones that believe that. We have the luxury of, in this case, being the largest shareholder in this company. I think we speak for 65% of the shares in the company, so we're in it with the shareholders. We feel the same pain that you do when the queues are late and when we're not moving along at the clip that we should. We are covered up, as I've said in the past, with M&A opportunities. That's probably, people have said, why are you here? Well, it's because we intend to buy a lot more companies as soon as we get these queues past BDO. And I think we have secured the financing to do these transactions. Obviously, we can't sort of lay out what it is that we're doing here, especially with my mother in the room. But there are plenty of deals. Plenty of deals that are accretive to EBITDA. I think that when we started this company, we put 10 companies together. There was a lot of turnaround work to be done. These were companies that were all losing a lot of money. So I think we went from, I think what you're going to hear is that we believe that we've gone from losing, at least on a GAAP basis, $20 million a year. I'm going to flip to only talking about cash EBITDA. So we believe, and we will show you a matrix that suggests that we could be on a pace in 17 and obviously experiencing the beginning of that in Q4, because that's your big retail quarter, to be in the mid-teens as far as absolute EBITDA goes. So somewhere around the $15 million of positive cash EBITDA and adjusted. For example, if I've taken 11 million of salaries out of this company already, 11 million of salaries. Well, some of those people have severance packages. When I say cash EBITDA, I mean, I'm taking credit for the fact that these are non-repeating expenses. We're going to move out of warehouses we pay at an above market rate to a 3PL in the UK, which probably costs us $2 or $3 million a year extra above what it will cost to do it ourselves. That's in my numbers. So I'm just saying that the variable on getting to a company that does EBITDA in the mid-teens and generates in absolute terms absolute EBITDAs in the mid-teens, is that we are on track, have identified by Social Security number and by project all of the reductions in cost that are available to us. I think, my mathematical philosophy on what it is that I've done over the years is that I believe in modern portfolio theory. I think that the math is that if you diversify, you reduce variance. And I think what shareholders really want is predictability. When you're buying losing companies, you don't know where it's going to end up. You don't have a lot of predictability. But by the time we're done doing 10 companies, we're seeing revenues come in very predictable ranges now. You see Q1, well, Q2 is not going to look a lot different. Q3 is not going to look too much different. They'll each check out probably, but Q4 will be where we expect it to be relative to last year, I think. So I think that we're achieving the things that investors would like us to achieve, which is predictability, and we're achieving positive EBITDA. And if you believe any of the numbers that I've put out there, this is a company that's currently trading at 2 times EBITDA. It's craziness, but yes, we're late on filings. Yes, if you look at old quarters, you're not going to see where we are at this moment, right? You got to look at what happened last week. That's the turnaround business. Turnaround business is not what happened in Q1. So what happened in August? I'm gonna get you there.
Yeah, we'll run through the deck.
Run through the deck and then I'll come back on.
Yeah, so, as John said before, the deck is in 8K, so you guys can look through it, but I just thought it's pretty fresh out there, so we can run through a couple of the key slides. Our name used to be CDSL, we changed it to match the company more. That was the old holding company, if you will, so we changed that. We just thought we'd remind everyone of that we used to be called a different name. But basically, at a high level, here are some bullets of what we like to do. Some important parts to note are the management experience that the team here brings. Between John and the CEOs of the individual companies, there's really strong leadership there. Many years in the direct-to-consumer space, which is really important to know the business very well because it ticks like really no other industry. In terms of, you've got to rally your sales force, and if people don't understand that, you can quickly slide in revenue. So it's very important that the team is well seasoned in that. And then, here's a quick brief history of where we went. It's hard to believe the company's only about 3 to 4 years old. We did our first deal in March of 2013, and now we're, on a pace to do between 150 and 200 million of revenue, which is pretty robust and pretty impressive given the purchase prices of some of these businesses. And then we can sort of talk about each of the brands a little bit. There's 2 slides here of all the brands. There's 10 total. The first 5 here are the material businesses. They represent about 90% of the revenue, so they're the bigger portion. But Clean Easy and Betterware are UK-based businesses that sell, door-to-door catalogs. They've been around for almost 100 years. Very well-established brands there, and they're great businesses because, given some of the industry scrutiny, they're very predictable, stable, been around forever, and they sort of keep out of that light a lot. And then we've got Agile, which is our very international business. It's in over 50 countries, sales in over 50 countries. Recurring revenue model of consumable supplements, which makes it very attractive to us. And then Longaberger is sort of our first acquisition, and one of our, we've talked about it, been a problematic child for us in terms of the revenue line, but with John Jr., we've hopefully got that stabilized, and we've seen a lot of good upticks in the attitude of the sales force there. So I think there's only positive things to come from that business, but they're a very old established brand out of the US mostly. And then the last sort of big company is Your Inspiration at Home, which we call our high runner, another recurring revenue of food products, so it's consumable, which makes it easier to sell. And they're mainly Australian based, starting to expand into Europe and Canada and the US as well, but mainly that one's Australian based, but it's really experienced some tremendous growth. You can see that in our filings in the segment of gourmet food. If you just track it from each of our filings, you can see sort of how it's performed. And then the smaller brands I won't go through, but they're there for you to read. And then, there's some more information here. And I think this slide is particularly important because I don't think we've been able to voice this really in any of our, filings or presentations before. This is sort of how we think about the cost structure, if you will, of a direct-to-consumer business. So you can read it yourself, but basically what we see it as is between cost of goods sold and program costs, discounts, commissions, shipping, and incentives, we see that combined to be about 70% of your revenue. And if you can control fixed, that last piece, fixed SG&A, if you can keep that at a low level of 15%, the business should, on a cash basis, be clipping at 10 to 15%, depending on where you get your fixed to. So it's a very good variable business model that way. There's a lot of variable operating costs, if you will. So if we can keep fixed in line, that should be what our target metrics are. This is again about our acquisition process. We vet tons of companies. We have a very robust deal funnel, which is on the next slide. We look for businesses that are underperforming or accretive in some way given their purchase price, given what the seller is asking for. So we try to buy things that are cheap and accretive to us. So a quick snapshot of our deal funnel really shows that these people have all contacted us looking for a way to sell their business to us. So we bought 10 so far, but there obviously, according to this slide, is plenty more, which is, as John alluded to, why we're here. We really are looking for more financing opportunities to buy, and then obviously we wanted to share everyone the opportunity with our stock. So that's more on the deal funnel side. And some about the management team I kind of alluded to already. This one's interesting. It's our global footprint, really. You can see, it's getting pretty global. We're working on South America and Asia, obviously. Asia is very interesting to us, particularly China. It's something we continue to look at and evaluate, but it's a work in progress. But I think we've got a pretty good footprint in 4 years' time. And then each of the businesses, sort of a quick case study. You can go through those on your own. An important thing to note is since we acquired both Clean Easy and Betterware, they're very, very similar in the way that in their products and the way that they deliver the products to the customer. So we see a lot of potential synergies there. Eventually, we would love to consolidate everything about the front end brands. The back end, the distribution's the same. The call centers are the same with their respective brands, obviously. But to the front of the house, it's sort of like the LVMH model, where you wouldn't know that Belvedere Vodka also is owned by the same company that owns Louis Vuitton. So the back ends are shared, but the front ends are separate. So this one's probably got the most potential overlap for cost savings. So we see a lot of potential in that one. Longaberger, Jillian, just sort of case studies. And then just a little bit on the industry as a whole. The industry is very, very popular and positive. It seemed to grow overseas mostly. The U.S. has seemed to slide a little bit, but it's made up of growth in South America and Asia mostly, and even starting to emerge in Africa, we're seeing it. So it's a very contra-cyclical business in terms of, where people are scared about the economy currently, they look for opportunities like our companies offer to supplement their income. So in markets that are developing is where the entrepreneurs are. So that's what we're sort of observing there. And then just some more, industry data you can look at. This is just on how the business model really works. And then I think these slides are really where the meat is of our presentation and our numbers. And I don't know, I can speak to them if you want. Or
That's fine.
Okay.
I'll do the next one.
Yeah, so basically, we took control of the company in late 2012, September 25th, 2012, and lately the stock prices appeared to be poor performing or lower than what people would like. But what we just wanted to remind people was with this slide was where we came from. When we started this thing, it was trading at less than a penny, and now it's up in that dollar range. This is reflective of the split, obviously. So it went from 8 cents to $1.04 in the last 4 years, which I think is really remarkable. And as you can see, the annual internal rate of return on that is 91%. So that's right in line with what John's historical returns are, which is I find very impressive. And it's just this one I just wanted to remind everyone of how far we've come in terms of stock price alone, let alone revenue as well. We started with zero and essentially between 150 and 200 million now. So in the next 4 years, you can only imagine what the business will look like. And then here's the sensitivity grid that I think outlines that cost structure.
Before I came up, I got another note from my handlers just saying these are just pro formas for how the industry works. This is how it should work. These are the percentages that we will achieve, we think we can achieve, that we've, if you look at the percentages, that's how the industry works. If you look at where our focus is now, it's on reducing fixed costs. So if you look at the fixed cost line and you know that we've reported 50 million, and then 44 million, and then 40 million, we know that we can get down into the $36 million range, and it becomes very easy to calculate what EBITDA is, what cash EBITDA is, because it's essentially revenues times 0.3 minus your fixed costs. So our objective here is to shoot a line through all of the reports that come out where, you know, we're writing things off. We are going to write things off. We are going to continue to write things off. I don't care if BDO writes everything to zero. It doesn't matter to me. We will write it down. You have to feed this monster of write-offs. And so we throw fresh meat at them all the time. They can do the write-downs if they want, but I think we've come to the point where people should say, what is your operating EBITDA? That's the key indicator. Because the M&A fixed is optional, right? We don't have to keep that overhead. We keep it because we're still in a deal mode and we expect to be in a deal mode for years to come. But you really want to look at the operating companies and see, have we fixed the operating companies? Are they generating cash EBITDA? Now, these numbers that I have up here include the M&A expense. So when I say 36 million is where we think we can get to, that's including 7 million of overhead associated with M&A. I think you can't do deals the way that we do deals without paying for help to do that. Right? You can't buy companies for 11 cents on the revenue dollar, which is our history so far, and expect there not to be some cost associated with buying right. You have to do a lot of due diligence, you have to kiss a lot of frogs, and it takes a large staff of competent, highly paid people to do that. But it's not a forever thing, it's not a perpetuity, right? We could turn that off, and then we would add 7 million back to, so it would take you from 15 million, if that were the number, to 22 million. That could be done anytime. Don't plan to do that because this is a 5 minutes. Okay. This is, as we said, an aggregation model. It's a federation of companies. The principle is that each of these brands stands alone, but all of these costs, like LVMH, has redundant costs associated with it, and it is there now that our focus has gone, having gotten 10 companies at revenues somewhere on that chart up there. So they're telling me that we're about out of time. If anybody has some quick questions, I'd be happy to field those. Yeah.
Looking at the cash EBITDA potentially run rate that we kind of discussed here today, do you think that's more of a base case? Is that a conservative case? Is that a pie in the sky, you know, if we hit a home run case? Or?
No, that's a base case. This is the way the industry operates. It's a very high margin industry, and this is without M&A. There's not a single M&A deal in there. So I'd like to think that at some point we would get a growth premium. Obviously we don't have that now, but when we establish that this is our run rate, when we do 2 or 3 more deals, and people see that they're accretive on the EBITDA side, when they see that we effectively, the rule is on these that you can take out instantly 20% of the fixed of a company that you acquired when you have the kind of shop that we have. You only need 1 accounting department, you only need 1 treasury department, you only need 1 insurance company to sell to you, right? So you consolidate all of these things and you look for cost savings, and right away it's 20%. I think it's much bigger than that in this industry. I think this industry gets carried away with excessive expenses. And so when we find these companies, instead of running at 15% overhead, they're running at 30% overhead. Well, instantly we know where to go, where to look, how to fix it, and that's the track that we're on right now.
One quick follow-up. Are you shocked or surprised that the stock is only trading at 2 times projected kind of EBITDA when, you know, really possibly could be a $5-6 stock?
You know, I have mixed emotions about it, really, because we are reporting late, right? So people penalize us for that. This is has been a messy turnaround. The numbers have not been predictable. But all of those, this is sort of a turning point here, I think. And I came here largely as a defense for myself, because I want to make sure that people understand what's happening here, because I don't like the dilution that I've experienced personally. This company is owned by family trust, my children, my grandchildren. I want to take my percentage up, but I want to make sure that before I do that, everybody has full knowledge. They know where we're at, that I've helped you interpret through extraordinary write-offs. I mean, 8 million of non-cash write-offs in this little company in Q4. We'll probably, when we do Q1, have even more write-offs. I don't know, but I want you to look at cash EBITDA. That's where you need to go.
I think we're out of time.
All right, thank you very much.
John's around the conference the rest of the day if you want to take a meeting. Thank you.